Hello all, and thank you so much for attending today's webcast, reviewing the markets from last year and mostly giving out an economic forecast for 2021, really talking about some of the themes that may or may not play out with two of our chief strategists and portfolio managers here at BFSG. So first off, to do a couple introductions for these two, although I know many of you already know them. First, Thomas Steffanci, a senior portfolio manager here at BFSG in our Phoenix, Arizona office. His main responsibilities being portfolio management and strategy, and also economic and investment research. Prior to joining our team here at BFSG, he was a managing director at Trust Company of the West, a director of fixed income, and a balanced fund portfolio manager at Fidelity Investments. He was also a partner in the investment advisor Analt, O'Connor, and Steffanci, and then also president of Glencrest Investment Advisors. Thomas earned a PhD in monetary economics from the University of Connecticut, a master's degree in economics and finance from the University of New Hampshire, and his bachelor's degree in economics from Providence College. Also online from Irvine, California, is Steven Yamshon. Steve is a managing principal and portfolio manager here at BFSG in our Irvine, California office. He's responsible primarily for security selection, asset allocation, and investment research. He is also currently leading the ESG, or environmental, social, and governance effort at BFSG. Steve has been teaching investment finance at UCLA for over 25 continuous years and has published over 40 academic research publications, conference proceedings, and case studies. He's also written 2 books on investments. Previously, Steve was also a visiting scholar at the UCLA Anderson Graduate School of Management and an adjunct scholar at the Mises Institute at Auburn University. Prior to joining BFSG, Steve has over 35 years of experience as an investment advisor and portfolio manager at Stevens First Principles Investment Advisors and Security Pacific National Bank, now Bank of America. Steve earned his bachelor's degree in environmental resources from CSU Sacramento, his PG diploma or master's from the University of Oxford, and his PhD in financial economics from the International Postgraduate School at the Universidad de San Jose, Fundación Empresarial, and his postdoctorate certificate in management studies from Oxford. Steve also does a lot of volunteer activities. Steve, can you give us a brief intro to some of the work we do with the forestry here in California?
Yeah, so I've been a volunteer with the Forest Service for about 35 years, volunteer field ranger. And one of the fun things about it is you get to meet interesting people. When I was single, I was wearing my uniform in the village in Lake Arrowhead, and all these cute girls came up to me and said, "Wow, are you a forest ranger?" And I said, "Yeah." She said, "Well, what do you do?" I said, "Well, we clean up toilets and pick up trash." And they just walked away.
Yeah, understood. So I got these 2 gentlemen on the screen right now showing some of their credentials, so you can see the faces of who you're talking to. You will also, hopefully, we're all on video, so hopefully you can see us, except for a couple of you that have dialed in on the phone instead. We've kind of separated this presentation into 2 themes, but really quickly, a housekeeping item. There's both a Q&A box and a chat box in your Zoom menu. If you have any questions throughout today's presentation, which should be approximately 45 to 60 minutes, please type your questions into the Q&A box and we will address all questions at the very end of the presentation today in the order they are received. I will also periodically post things in the chat box, especially at the very end, with a survey link to hopefully all of you have to respond to a 1 to 2 minute survey to let us know what you thought of today's content and kind of help guide some future presentations we will do for this group. With that, let me advance this. Our first theme today that I'll ask Steve and Thomas to talk about is, thinking about, will history repeat itself? So with that in mind, gentlemen, kind of question number 1, the Spanish flu, right, gave way to the roaring 20s. Business boomed, stocks climbed, and new credit innovations fueled a general investment mania here in the United States. Then in 1999, credit was easy, the business boom, we had the dot-com boom and eventual bust. Are these times similar? Is there any chance that we might be experiencing deja vu in today's market?
Well, if we take some of these slides here, it was interesting last February when the market started to really downdraft. I wanted to see if there was any correlation between 1920s and 2020 really. So on the left-hand chart, I wanted to see how much debt there was by the end of 1929, because when the Federal Reserve started to raise interest rates, the stock market cracked in 1929. So we can see that, you know, people were on margin debt. It was quite high at that point of time. And people were borrowing from the bank. They were borrowing from their neighbors, anything to speculate in the stock market. But, you know, we also have to remember that the reserve requirement in those days was only around 10%. Things are different now. The Federal Reserve requirement is 50%. So you know you're not going to have that kind of borrowing, at least for this kind of speculation. If we look at the right-hand chart up on the top, the volcano, that was pretty much at the great financial crisis when debt peaked. And after the great financial crisis, people started paying debt down, and the debt levels started to become much, much more manageable. But we can see that it's starting to rise again. And I'm getting a little concerned with all the option trading activity that's occurring in the last few days with stocks like GameStop, AMC. And then I got a report from London today that they're doing the same thing with Cinemark, Odeon, and some other stocks that they're you know, buying options, which you know you pretty much need to do in a margin account. Tom, do you have anything to add to that one?
Nope, nope. The only thing I would add is that it's interesting that if you look at 1930, corporate and municipal bond yields were around a little over 4.4%, whereas today they're down around 2%. So in terms of carrying that debt, it's a lot more cheap today to carry debt, whether you're a householder or a corporation, than it was back in the 1930s.
Okay, good.
Yeah, thanks for adding those comments, Tom. So thinking about this and thinking about where we might be in the credit cycle, thinking about all that's happened in 2020 with the COVID-19 pandemic. We've talked about a V shape, W shape, and all these things. And I think new K-shaped recovery. What is meant when we say a K-shaped recovery?
Well, if you look at the next slide here, it's a representation of the uneven growth that's occurring in the economy since the shock of the recession. And you can see that line down on the left-hand side was obviously the recession shock. And the recovery, you can see, which is basically phase one, as that began in April, it was mostly a recovery in manufacturing. And if you can see all the way up until the present time, manufacturing looks like a V-shaped recovery. And that's where a lot of people thought that the entire economy was going to be a V-shaped affair. Not so. What happened was, as people hunkered down and stay at home increased, and uncertainties of the spread of the virus and how serious it would be, people began to hunker down and not spend. And even though there was a $2.5 billion stimulus, people saved most of it. About 60% of that was saved. So a lot of the lockdown during this period was as you see here, jobs and services, restaurants, bars, entertainment. And so we had basically this increase and then a big decline, which is on the right-hand side under jobs and services. So if you sort of look at that stall and you look at the V-shaped recovery in manufacturing and sort of look in between there, the aggregate economy is basically following that checkered and dotted line. So that K is really going to become something like a check mark. The important thing to note, though, is that we haven't really seen the burst in employment and in retail sales that are likely once the $900 billion stimulus becomes more active and distributed. Households getting $600 per person. That's going to boost the economy here. And the record savings that have been accumulated during this whole pandemic, as the economy's lockdowns are eliminated, are going to flow into the economy and really give a big boost to retail sales, consumption spending in general.
Yeah, so in thinking about this, and I think we're talking about real history repeat itself. So I'm going to talk a number of themes before we get into like interest rates and the stock market in a few slides. But I wanted to move on quickly to housing too, especially I think in your two demographics being Southern California, Phoenix, Arizona, housing is definitely booming. Same across a lot of the rest of the United States. You think from the Pacific Northwest and Spokane or Boise, all the way to the East Coast and Florida, probably everywhere except a major metropolitan area that COVID has really impacted. So with that in mind, and interest rates at all-time lows, is there any chance the housing bubble bursts in 2021?
If you look at the next slide, it tells really two stories here. The first story is on the left-hand side, housing starts, and that blue line is single-family housing starts, and you can see over this entire period that we basically have a record housing start environment. Builders are very positive. Their sentiment is historically high. Apartments, by the way, these multifamily are not as robust, but single-family housing is at record or near record levels here. And that being said, it's what's happening. We have, as you said, low interest rates. We have affordability. We have a lot of home equity that is tied up in the current housing stock that likely is going to be spent on new homes. There's another side of this though that bothers me, and that's what the difference between how optimistic builders are, which is that green line on the right-hand chart. That's at very, very high levels, and how muted home buyer sentiment is. And that spread there is we have not seen at least in the last 20 years. And the reason for that is that households have become very conservative, locking down, not wanting to risk infection, and so they're staying at their homes. And going out and looking for new homes has not been particularly attractive to many people, and so home buyer sentiment tends to be and is pretty low. Now, is there a bubble? I think so. There is an inventory of land has dwindled. Home prices have gone up by almost 10% over the last 12 months. There are waiting lines for good homes in suburban areas. But historically, what really produces a bust or a burst is interest rates. If interest rates begin to meaningfully increase, and we think we're going to see some increase in interest rates throughout the year because of the ebullience of the economic landscape over the next several months, I think what's going to happen here is that other than a burst and a bust, I think it's going to be a pinch. I think you're going to start to see some softness in housing as home buyers retrench on these kinds of home prices that posted. So I think over the next several months, you're going to begin to see a flattening out of the housing curve, where home builder sentiment will begin to decline. Home buyer sentiment will increase some. But I think we're going to see a housing environment that will be much less ebullient as we go forward, with some flattening out of prices and some declines in housing starts.
Yeah,
So then, go ahead, Steve.
Yeah, I would concur with that, I think housing is going to be okay until interest rates rise. What is that interest rate going to be? Who knows? But, it'd probably be somewhere north of 2%.
So in thinking about this with real estate, it sounds like both of you thinking it's pretty high right now. I know across a lot of markets, people are thinking the same thing. So let's look at the stock market then. Are stocks getting ahead of themselves? And if so, what are some of the signs that you can point to that say that the markets are becoming overextended?
Okay, taking a look at the next slide here, these are some kind of gauges of what's going on. If we look at the top left-hand side of the left slide, it's the U.S. Financial Times IPO index, and we can see that the IPO index is really now at a 2020 high. But more telltale than that is simply the percent of IPOs, initial public offerings, that just aren't making any money. We know in the dot-com burst of 1999, 2000, there was a lot of IPOs that shouldn't have come out to market, but companies, they want to cash out, and that's what they're doing. And we can see it's now hitting a peak. And another sign is what's going on today. And I think it's a sign of more trouble than what we really expect. And that is what's going on in GameStop. GameStop is a company that sells video games in little strip malls and retail centers. And they haven't been doing well because gaming is going online. People can purchase these online. You play games online, and their business is really deteriorated. But the big hedge funds have short squeezed GameStop. But the people on the other sides on Reddit, it's like an army that they want to just search and destroy these hedge funds. So it's the haves versus the have-nots. And now GameStop has a market cap of $26 billion. That's incredible. It was up 185 points today. Just about 2 months ago, it was at 13. And these are just not great signs of a stable stock market and of a market bubble. If we go to the next slide, we can take a look at Tesla, right? Tesla now has a market value of more than every single car company in the world. And, in China, there's NIO, there's some others, BYD, there's other car companies that are going to compete against Tesla. There are, in America, Ford, maybe GM might have a chance. This is kind of crazy. Today, Elon Musk came out and he encouraged the people on Reddit to go after the short sellers in revenge for the short sellers going after Tesla. And what's occurring to me is, the signs of a possible market top. I think on the next slide, oh, maybe not the next slide. But anyway, I think that, we see these kind of signs. Now, people can stay exuberant longer than they can stay solvent. So we don't know, and I think it's pretty difficult to time the exact, when it's going to happen at a market top. But generally, what pricks market tops are rises of interest rates. And I'm not sure that the rise in interest rate that we're going to see will prick the bubble. So this could go on for a long period of time.
Yeah, thanks, Steve. I like the John Maynard Keynes reference that we shouted out right there. And so with that, I think, moving on and kind of getting away from this idea of history repeating itself through the various different markets we just talked about. I think that what's on a lot of people's mind is recession, interest rates, in the stock market. And so thinking about low interest rates and the Federal Reserve and all these things that you just mentioned briefly, we hear that Federal Reserve liquidity has been responsible for driving all this market boom for the last several years, not really corporate earnings. So can you guys define liquidity, what it is, and kind of speak to this a little bit?
Yeah, this next chart is a chart of the Federal Reserve's balance sheet, and that is the blue line, and that is basically all of the securities and loans that the Federal Reserve makes, and the securities are government securities and mortgage-backed securities that they buy in the open market, and as they buy those in the open market, they are able to basically exchange those securities for liquidity. So if you have a CD or a checking account and you buy a treasury bill, your account's going to be debited and it's going to go into the Federal Reserve. And so their balance sheet is an accumulation of all of those treasury securities that are denoted by that blue line. That red line is the S&P 500. And you can see that over time, over the last 10 years for sure, there's been a directional correlation between what the Fed has been doing and what the S&P 500 has been doing. So as the Fed has been buying all these securities, it has been providing increases in checking accounts and demand deposits and all other liquid instruments to the private sector. And so what are they doing with it? Well, at very low interest rates, money doesn't stay in zero interest banks for too long. What happens to it? It goes out and buys assets. Well, what kind of assets? Stocks, bonds, real estate, financial and real assets. So stocks have been behaving very much in tandem with the liquidity that's been provided to the private sector by the Federal Reserve. And especially over the last several months as the pandemic raged and all of the lockdowns and the reductions in economic activity have occurred, the Federal Reserve has actually doubled and tripled the amount of securities that they have been buying. And just like lockstep, the S&P 500 has gone right along.
Yeah.
The next chart shows something that has really not been given a lot of attention in terms of how liquidity is withdrawn or added to the economy. The blue line is just the Treasuries, the Federal Reserve's holding of Treasury securities. So these are Treasuries and mortgage-backed securities. The red line is the government's checking account at the Federal Reserve. That's the red line. And so when the government goes and floats Treasury bills and bonds and sells them to the public pays the Treasury by putting money in the Treasury's checking account at the Fed. It's called the Treasury deposit account. And you can see that we've had a dramatic increase in Treasury deposits, especially since the beginning of the year and all the way up to the present time, where that account was about $400 billion in January of this year, and it is now around 1.6 trillion. Well, how did that happen? Well, first of all, it happened because the Treasury is issuing all of these stocks and bonds and taking money out of the liquidity stream and putting it in its own account. Now you can see that blue line. That blue line, the Federal Reserve is buying treasuries like crazy. And basically most of the treasuries they're buying are the treasuries that are being floated by the government. And so it's trying to stay ahead of that red line so that liquidity doesn't go down on net. But here's the problem. Given the stimulus that occurred last year, all of that money, the Treasury has not spent. It still resides in their checking account. So now you have a situation where the Treasury has $1.6 trillion that basically has to be spent. And by law, that $1.6 trillion has to go down to $50 billion by August of this year. Well, what the heck is going to happen? Well, what's going to happen is that they are going to have to find some way to reduce their Treasury deposits and get that liquidity into the income stream. And the way they do it is to tack on extra expenditures, more than that's been announced or contemplated. And my view is that $1.6 trillion, a lot of it is going to go into infrastructure spending. And that infrastructure spending is probably going to begin earlier than is anticipated. And that's going to be an unexpected boost to the liquidity in the economy. And guess what? To stocks, bonds, and real estate.
Yep. It seems crazy to me, gentlemen. If I think back to pre-financial crisis 2008, right, and the Fed's balance sheet was around like $800 billion. A trillion wasn't even a word. And it seems like today it's just a trillion here, a trillion there. Like, what's another $1 trillion or $2 trillion in stimulus? It's a very different feel. Only 12, 13 years later. But go ahead.
It is, and Steve has a chart coming up that shows in what form all of that liquidity has taken. In the marketplace.
So in getting to corporate earnings, guys, I mentioned corporate earnings, at the beginning when we started this,
Yeah.
and it's really been the Fed and liquidity boosting the market, and I think there's a recognition that corporate earnings have not kept up.
Yeah,
Can
and
they?
yeah, if you look at this chart, the blue line is corporate earnings, corporate profits after tax. The red line is the S&P 500. If we had a longer term chart that went back 20 or 30 years, you would see those two lines basically converging. They would be right on top of each other. And that goes to the premise that we've all used, is that over the long run, stock prices follow earnings, except for now. And what's happened is that corporate profits, despite what you may hear and see on TV or on the internet, corporate profits after tax have not gone up a lot. You can see that blue line. And so what we've seen is the difference between the S&P 500 and corporate profits has been liquidity. That's the difference. And so the liquidity effect of the Federal Reserve and also coming up the Treasury has really given the S&P a major boost relative to earnings. Now let's look at the consensus estimate for corporate profits this year and next year, and that's where those two dotted lines represent. So these are optimistic estimates because analysts typically are not very accurate in forecasting 1 or 2 year ahead earnings. As a matter of fact, most of the time they're wrong. But let's assume the optimistic consensus forecast for 20% earnings growth in 2021 and about 10 to 15% in 2022. That's what those arrows represent. Well, as you can see, even under the most optimistic circumstances, it's not going to be possible for earnings to catch up to stock prices. And so the Federal Reserve is going to have to continue to support the financial markets, basically to prevent a meltdown. And so they are going to be active, continue to be active. And if you recall recently a comment by Chairman Jerome Powell of the Federal Reserve, he made the quip that I'm not even thinking about raising interest rates. So that shows where his head is. And so liquidity is going to continue to be ample. And any increases in interest rates that are likely to occur because of the robust economy and the increase that we're starting to see in commodity prices will tend to be muted by the fact that liquidity will still be amply applied to the private sector.
So in thinking about that, what that seems to tell me is the S&P 500 seems that's pretty extended. So with that in mind, pulling up the S&P 500 and also thinking about price to earnings, which we also show on this slide at each inflection point. Can you kind of speak to it? Is the S&P overextended and is it right for a pullback or correction?
Yeah, there are two faces to this chart. Okay, the first face is that 400% increase in the S&P 500 from the bottom in 2008 all the way up to the top. Then we had the 35% decline in March, and then we had another big increase due to liquidity up until now. This is a scary looking chart, and it looks like really, I mean, we are fully extended and just holding our breath for a decline. But let me give you another side of the story here. If you look at the inset on the chart, and you look at the last row, which is 10-year treasuries. In 2000, March of 2000, 10-year treasury yields were at 6.2. And today, they are at 0.9. And if you look at the second row, the PE ratio was 27.2 in 2000 and 19 times earnings in 2000 in last year, a year ago, and now it's 22.3. The issue here is rates are an important valuation for stocks, And interest rates are dramatically lower now than they were in history. Dividend yields, 1.6% versus 0.9 for bonds. Historically, bonds yield more than stocks. They are no longer superior in that case. So you've got some evidence that what's going on now is unprecedented, and it is much unlike recent history. Now, that doesn't mean that we can't get a pullback in stocks. Both Steve and I suggest that we're going to see probably a nice pullback. For me, it could be 10 to 15% at some point during the year. But the levitation that we're seeing stocks and other assets are the result, in my view, of having very attractive dividend yields on common stocks, paltry yields on treasury securities. And because of that, we're seeing a historic flow into stocks.
Yeah, Chad, I mean, I have a view on it, and that is three basic things. First of all, the S&P 500, what's really driving it since 2012 has been really Facebook, Amazon, Apple, Netflix, Google, Microsoft, Salesforce, these kind of stocks. 400 and let's say 80 something of the 500 S&P really haven't moved all that much. So, we see that the movement in the S&P is just to a handful of stocks. That's a little bothersome. The second thing is your favorite person, John Maynard Keynes, talked about the beauty contest. And the beauty contest was not the most beautiful woman who won the beauty contest, but the ones who think is the most beautiful person who won the beauty contest. In that case, it's Facebook, Amazon, Apple, Netflix, Google, and Microsoft. The PE, in year 2000, when the dot-com bubble burst, they said, well, okay, yeah, you know what? I think I'll buy Cisco versus Qualcomm because it's relatively cheaper. To me, that's always a dangerous game. And I think what this is telling me is when the PE crosses 22, it's time to be cautious in the sense that I don't think you have to completely sell out everything and, put everything in a mattress. But, when you're going in and buying now, you certainly have to be certainly cautious. I like to view it as three pots. When the economy is really hot, it's on fire. When the economy is really cold, it's on ice. And in between, it's mushy. And I have to say, the stock market right now is on fire.
Yeah, I like to think back is your comment on the S&P 500 driving it. And I think it's the top 5, if not top 10 names are more than 20% of the S&P 500 index.
Right.
So you got another 490 stocks that are performing nowhere near as well. And so as much as we might like to say the S&P 500 is overextended, you have 490 stocks that could easily continue to push the market higher, even if those big tech companies were to stall out just a little bit.
Well, they could, because the average PE of those 490 some stocks is 5.5 times earnings. 15.5 times earnings. So exactly. Much below what you're seeing with the stocks of the top 10.
The other point, Chad, is, and I think Tom would probably agree with this. I think so. We've discussed it, and that is, when the market becomes overvalued, evaluation gauges are almost meaningless in a sense. It's very difficult to try to say, okay, the market is going to pop because of a valuation gauge. So you have to be really, really careful with that, because like we said, the market could keep going higher because of liquidity. Once the liquidity stops, okay, that's another story. But if the Fed is committed to just pumping money out, and if what Tom says, that there's just all this money sitting in the Fed checking account, the market could still go higher.
Right. Yeah, right. And and Steve knows this as well, is that market tops virtually do not occur because of internal problem with the market. Market tops typically occur because of an external event, such as increasing in interest rates.
Yeah.
Interest rates historically have been the instrument for market declines, especially when markets are as extended as they are now.
Absolutely.
Yeah, it takes me back. I had a lot of friends during financial crisis, friends, family, et cetera, that, went to cash because of the financial crisis, getting scared about the markets. And, 5 years later, they're still sitting in cash. And if you're looking at this chart, you were back to all-time highs 5 years after the financial crisis. And all of them are now scared, saying, okay, we're back to all-time highs. Do I really want to put my cash in and risk losing even more money, only to have now missed out on what was the longest bull market in the last 120 years? And market timing is hard, right? You got to be right at least 2 times. One, when to get out, and when to buy back in. And if you miss either one of those, then you completely destroyed your performance.
That's why we go to cash and put it in the mattress.
Yep. So with that, guys, we kind of be in the equity markets up quite a bit. I think there's possibilities of going down, possibilities going up. And we're going to talk about interest rates a little bit, but before we get there, especially because they're considered an inflation hedge in the markets, I did want to briefly touch on commodities today. So can you guys explain to me why commodity prices have begun to increase pretty sharply, especially in the last quarter? And are there any potential consequences of this?
Yeah, there are. If you look at this chart here, there are 2 in one. On the left-hand side, the black line is the index of industrial production. And you can see the huge V-shaped recovery in March and April of industrial production. Now, if you're a manufacturer or a utility or a goods producer, you are going to demand inputs, and those inputs happen to be labor, capital, and materials, commodities. And that big sharp increase has put upward pressure on commodity prices that are particularly sensitive to things like construction and all types of manufacturing. Copper, for example. There's lumber, zinc, silver, the hard commodities, the industrial commodities. And so you can see the green line has really followed industrial production up, very close correlation. The two commodities that are most visible in this index, this commodity index, are copper and gold. Copper is used everywhere. Just name a commodity or a product that doesn't include some kind of copper content. Semiconductors, automobiles, aircraft, construction. It is a widely used industrial material, and typically reacts very sharply to changes in economic activity that's shaped by the users of that commodity. Gold, on the other hand, is a store of value. It functions as a safety valve for investors that think the world's going to come to an end, or that inflation is going to be double digit or triple digit. So if you look at the difference between copper and gold, copper is sort of the industrial material commodity, and gold is sort of a safety commodity. So if you look at the ratio of copper to gold, and that is the black line, and you can see that that it obviously A, it's volatile, and B, it follows the business cycle. The red line is 10-year bond yields, and you can see the remarkable correlation between that ratio and bonds. That is, when copper prices relative to gold prices go up, it means the economy is expanding. There is some expectation that commodity inflation is going to get worse in the future, meaning go up further. And so you see these sharp increases and decreases in this ratio. If you look at the far right portion of this chart, you can see the black line, the copper gold ratio, bottomed earlier about in mid 2020. And in 2021, which was about several months ago, April, you had a bottom in 10-year bond yields at 0.5. and that's on the left-hand axis. So you can see that we've had an increase in 10-year bond yields that have been consistent with an increase in commodity prices. Now, it's likely that if we're right and that economic activity in the next several months is going to expand briskly, at least in my opinion, it's going to be greater than I think what the consensus expects, partly because of this big liquidity injection from the reduction in the Treasury checking account. I think that is going to continue to put upward pressure on commodity prices, and interest rates are likely to follow that. And I mentioned earlier that increases in interest rates, if left to their own devices without the Federal Reserve with this liquidity bucket in the background, bond prices, interest rates in general, could be up to 2% or higher this year, given what's likely to occur in the economy in the next several months. I don't think that's going to happen. I think that the increase in interest rates are going to be muted because of that liquidity bucket. My own view is that 10-year bond yields probably can go up maybe to 1.5%, probably not further than that, which is not a big deal in terms of the stock market, as long as the Federal Reserve is known to be there. If things get out of hand, I think that that level of interest rates is not going to impede economic activity.
Yeah, I think the other reason commodities are going up is the dollar is going down. We've had a rebound in the dollar because it's kind of a safe haven currency, and when the COVID thing starts to flare up, especially like the mutant varieties, people get scared. They dump other assets, move into the dollar. But there's definitely a correlation between the dollar and commodities. When the dollar goes down, commodities go up. The demand for oil has dropped. I mean, Tom mentioned a couple of weeks ago that, and I had forgotten about this, is oil prices were negative. You had to pay tanks in Oklahoma and Texas to store it. But now oil has recovered to about $53 a barrel. So I think, if the economy gets open again, people are going to start driving. Oil probably move back into the 60s and $70 range there. So yeah, but again, a lot depends on the dollar. I think the long-term trend of the dollar, and that's always a tricky thing to forecast. You're always going out on a limb there, but I suppose the long-term trend is down.
I think so. I agree with that. And these commodities, by the way, internationally are traded in dollars. And so when the value of the dollar declines, you can use less dollars to buy commodities, and that puts upward pressure on those prices.
Yeah, thanks, Jess. So in thinking about low interest rates, we talk about commodities, potential inflation. So let's talk about inflation for a minute. So on the next slide here, I have, we talked about it. At some point, interest rates have to go up, right? And right now, the market's doing it themselves. As both of you have mentioned, the Fed's kind of said, yeah, we're not even going to think about raising rates for the next, probably 2, if not 3 years. But we have seen the 10-year Treasury tick up to above 1%, since being around half a percent only a few months ago. So with that, and interest rates are going to rise, by how much? And with that, where do you think inflation might be in the next 3 to 5 years?
Steve, you want to start that, or?
Yeah, taking a look at this slide, what I think what the Fed really cares about is real interest rates, and they're negative. So think about it. If inflation is, and I'm going to use an example, let's say inflation's running 2% and interest rates are 1%, it's a negative real rate. People don't really care about the nominal rate. They only care about the real rate because that's what purchasing power does. That's the things you buy. And we can see that the rates are negative. But as long as they're negative, then, gold, things like gold should be okay. I think what would happen is when the output gap closes, which is the difference between the real economy and the potential of which is the difference between what the economy is doing and the potential of the economy. What's that going to do? Well, if the output gap closes, and it's quite wide now, then you'll have a potential of inflation. I don't believe you can have inflation when the output gap is open as it is now.
Yeah, so in thinking about that, and especially I think where inflation is today and where interest rates are today, what is the long-term impact of inflation running ahead of interest rates?
Well,
negative yields, can't be sustainable.
Well, first of all, banks are going to be in trouble because deposits are going to dry up because they are low yielding, and with inflation running ahead of short-term deposit rates, CDs, time deposits, saving deposits, people are going to disintermediate the banks, and they will look for securities or other instruments that will give them a return that will either equal or be above the inflation rate. So the banking system itself will be disintermediated because of this issue. Now, what does that also mean? Well, what it means is that the banks basically are the first repository of Federal Reserve buying treasury and mortgage securities, because banks are very important buyers. Well, they can buy them, and they put their money, to the excuse me. They put their money to the Fed, but they also go into the banks, and the banks, I think, are going to be at a disadvantage. The Fed is going to have a hard time trying to convince the banks to be holding securities when their depositors are leaking out the back door.
Yep, understood. So in thinking about that, guys, we've talked a lot about interest rates, real interest rates being negative today, equity markets being extended, but a lot of that possibly being in the big tech companies, leading the way, and the rest of the market kind of being left behind. So maybe some room. So with all of that in mind, what are the potential catalysts you guys see in the market? It's been a little bit bearish type of presentation and outlook. What are the catalysts you see in the market today for potentially continued growth?
Well, as I said before, it'd be very tough for inflation to take hold until the output gap, closes. And if you look at the left-hand top chart, the output gap is -5. And again, that's the difference between what the economy is doing and the potential economy is doing. Eurozone, these guys, they're going to be struggling for a long, long time because they're bickering among different nations. They may have a common currency, but they have different cultures and different political views. If we look at the bottom left-hand chart, China was pretty quick in getting their economy back on track. They got the pandemic over quite quick. They closed the output gap quite quickly. But the right-hand chart is very telling. It just shows how much pent-up demand there's going to be, because a lot of folks have saved their stimulus money, or people haven't spent money. They're not going to, movies. They're not going to restaurants. They're not traveling. They're not buying cars. And you can see the pent-up demand. It's dropped a little, but that's got to go somewhere, and it's going to most likely go into the securities market. We can see the same thing worldwide, Japan and Germany, all the developed countries. So you've got this soaring savings rate that just underscores a ton of pent-up demand. I don't think Tom and I've, given you a super bearish view of things. I think we're just giving you a realistic thing that, things aren't as rosy as the game stoppers think they are, but, having a diversified portfolio and maybe being a little cautious right now might just be a prudent thing, which means in the sense that, it'd be very foolish, like you mentioned, Chad, to just squirrel away your money in a mattress.
Yeah, thanks, Steve. Thanks, Tom. So as we try to wrap it up, we have just a couple slides left today. Can you two kind of go through and summarize some of the key points you've talked today? I got 4 of them up on the screen. Economy recovering, et cetera. Can you kind of just summarize all the different things we've discussed today for the audience?
Well, on the left hand, economy recovering. I mean, that's key. It is recovering. The only question now is how fast will the recovery be? And that's really a function of vaccines and the incidence of lockdowns. But it's also a function of how fast fiscal policy is going to be able to affect the growth rate of the economy. And that means that the stimulus hopefully will be effective sometime at the end of the first quarter, April or May, and that will be into the economy at that point. But prior to that, the economy is going to be, the first quarter of economic growth is going to be positive. The fourth quarter, the one that we're in now, is likely to be what's going to be announced. The preliminary number is going to be announced tomorrow. It's probably going to be 3 or 4% real growth. But the economy is recovering, and unless something way out of the ordinary or expected happens in terms of vaccine distribution or another spike in infections, I think the economy is going to be not only recovering, but be in an expansion stage by the end of this year. Expansion meaning the level of economic activity in real terms will be higher at the end of this year than it has been ever.
Yeah, I mean,
but there's uncertain. Oh, go ahead. I was just gonna border that with there are uncertainties here. Nothing is really predictable with a high degree of confidence. Black swans can happen, outliers can happen, and we don't know what the policies of the Biden administration are really going to look like. There's all kinds of questions and all kinds of opinions about whether it's going to be whether regulations are going to be too tight, whether we're going to have this total lockdown of fossil fuel production. I mean, there's lots of uncertainties here that are blanketing what I've just said, and we don't know. We don't have a good probability distribution. Let me put it that way, of the events that could come to play to hamper economic recovery and expansion.
Yeah, I mean, like Tom said, certainties around, uncertainties are around. But when aren't they? Really, if you think about it, just go back at any point in time, and there's always some crisis or something happening in the world. There's just a couple things that maybe bother me more than others. I'm not too happy about the Eisenhower task force group moving into the South China Sea, but that might mean nothing. I'm certainly not going to, mess with my portfolio over that. But one uncertainty that most people don't think about is the social unrest thing. Now, the social unrest thing has been happening for over a year. Then it accelerated with the storm of the Capitol building. Then there's been some social unrest again in Portland and Seattle, ironically not liking what Biden is doing. And then, this thing with the stock market, I don't know if that's a, social unrest thing or not, but I suspect there's going to be increased social unrest coming up. I don't think this thing with Donald Trump is over, if you liked him or not. I'm not being political here, but you got to remember, I don't know, was it 71 million people who voted for him? That's something to consider. So again, I like to go on my risk on, risk off, which, which basically equates to, is it the economy on fire? Is it mushy growth, or is it ice? So, we're probably on fire, but maybe moving to mushy. But the best remedy, the best prescription would be, not to take 2 aspirin, go to bed and put your money in the mattress, but have a good diversified portfolio there, stocks, bonds, maybe a little gold, whatever your portfolio manager suggests, and keep some cash ready for when there is a downturn to buy some good quality stuff that just got hammered, but that have long-term prognosis. I think when I look at at charts that show the long term, those who kind of just stick it out and ride it out, like you said, Chad, do fairly well over a long period of time. It's the one who try to market time, they have poor returns. So I think it's very difficult to time a top or a bottom. But again, what Buffett says, be greedy when those are fearful, and a little cautious. I'll change it a little up when those who are greedy.
Yeah, so we actually have a question that I think we'll let you guys kind of address, where there still might be some opportunities around value versus growth. But before I get there, you guys both started to allude to politics a little bit. So I want to throw a little curveball, because I assume that everybody that's attending this thing is kind of like, okay, we went through this entire presentation and you mentioned Biden and Trump, twice now. That's it. Are there any, or do you see any potential policy changes that could impact the markets in the economy, especially in the near term?
Oh, absolutely, absolutely. Regulatory changes and the threat of tax increases don't affect financial markets or in particularly the stock market when they're about to happen. The stock market is forward-looking. And so everything that's being talked about in terms of regulatory changes and tax increases, including capital gains taxes and estate taxes, are all part of the calculus now of how investors are looking at the next 6 to 12 months. And so the tax issues, I think, are extraordinarily important. As well as regulatory changes that could impinge upon economic activity. So I'm very interested in trying to figure out how the increase in taxes and the regulatory positions of this administration are going to affect sectors of the market. Obviously, energy is the prime bullseye, and that is on the top of my list.
Yeah, I mean, I think if Joe Biden sticks to what he talked about when he was running for election, he raises the tax rate from 37 to 39. I mean, simple economics tells you that when you raise taxes, people spend less on other things, but the Fed will neutralize that. The stimulus will neutralize that. So I'm not really worried about that. If there's a Elizabeth Warren, Bernie Sanders type wealth tax, that might have a different kind of perspective because it'll affect capital formation. Joe Biden taxes stocks and bonds every year, like some of the senators were doing, instead of upon sale. Yeah, I think that's going to be problematic. If Joe Biden taxes capital gains at the personal tax rate, yeah, I think that's going to be a problem. By canceling the Keystone XL pipeline and no drilling on federal land, you know what? That's a gift to the oil markets as far as I'm concerned. And that's fine. I have oil stocks. But what will happen is, instead of sending oil down through pipes, they'll go back to sending it on freight trains, and there'll be oil spills and environmental issues. So I have to agree with Tom. We don't know what the regulatory aspects will be. If it's moderate, it's not going to be the end of the world. If it moves towards the progressive side of things, yeah, then you're going to have some problems.
Yeah, thank you, gentlemen. So as we wrap up today, before we get to, I do have a few questions in the queue for you, gentlemen. But before we close, I just want to put up on the screen for everybody some contact information. If you have any questions or would like some more information on what was presented today, we have both email addresses and phone numbers where you can reach out to schedule a call with either Steven or Thomas. How we can help you is, again, schedule an appointment to discuss these concepts further. It's always a good thing when you're thinking about some of these big themes in the markets and economies to evaluate your financial plan. And you can always expect upfront, unbiased advice from all of our teams here at BFSG. At the very bottom of the screen, for any timely content or topics, including even one Steven did on Bitcoin a little while ago, that BFSG University link at the bottom of the page includes links to any of the past webinars and content that we recorded, where you have links to register and rewatch any of those things. In thinking about doing a financial plan, here's a team of financial planners that are here to support Steven and Thomas and all of our clients here on the financial planning side, all with an average of over 10 years of experience here dedicated to answer any questions you might have, in Steven and Tom's as their assistant. Now, for anybody that has to drop, I did just post in the chat box a link to a 1 to 2 minute survey. We would love it if you would take just a moment to let us know your thoughts today. But let me take this moment to jump into some questions. We definitely have a couple really good ones. As a reminder to you all, there's a Q&A box at the bottom of your screen. If you have had any questions or want some clarification on anything that was said today, please type your question into that Q&A box, and we will address all of them in the order they are received. With that, Steve and Tom, let me get to the first one we have. Based on everything you said, should we get out of the markets based on the valuations and the recent run-ups in stocks?
How many ways do you define the word no?
Yeah, I think that probably goes back to the idea that you just never know, right? That's again, trying to time the market. Is as much as we say stocks can be overvalued, at the end of the day, this can continue for another 1 year, another 5 years. It could all come crashing down tomorrow. Nobody really knows what is ahead.
Yeah, the problem.
Go ahead. Yeah, I mean, the answer is we don't know. But we could basically make sort of calculated guesses, and basically what I think is going to happen is the Federal Reserve is going to be the pilot here, and with record deficits and increasing debt, it is required for solvency for the United States to be able to continue to finance at very low interest rates. And I think the Federal Reserve is going to see to that. And as long as they see to that, and the Treasury and the government continues to finance, I think we're going to be okay. I don't think we're going to see any disasters in terms of huge drawdowns in the market. I think from time to time, we're going to have pullbacks or corrections. But I think the trend in stocks is up, but it's going to be more ragged than we've seen in the past because of the new normal that we've got in front of us. But I don't really think that we would expect this liquidity gravy train to stop anytime in the next 2 or 3 years.
Yeah, Chad, I would have to agree with Tom. In the sense that, if you jump out, the question is, when do you jump back in? You're never going to catch the bottom, and I had a customer call me today. They're very upset. They've been sitting on a lot of money. They didn't have it invested. They were afraid to. Now they want to jump in. So they missed a heck of a run. So, the best protection is just diversify your portfolio. And I think, the portfolio managers at BFSG do that. I mean, we know how to do that. And I'm certainly not going to, sell my stuff. And I have some cash. And if the market takes a correction, which it does from time to time, I'll buy some more stuff, because I'm not thinking about 15 minutes. I'm thinking about a year or two down the road.
Yeah, so I think this all goes really well into the next question we have here from Dirk. I'm going to paraphrase it, Dirk, so please don't be mad at me. But given the multiple points we've presented today, really can we consolidate kind of the net message? And this is where I'll paraphrase a little bit: is that the year is going to be volatile, but in the end, are we assuming that because of the continued Fed backstop, markets are likely to be up overall, since the alternatives to the stock market, especially thinking real returns being negative, remain very limited? Is that kind of the thesis that you two are getting at?
I think I would agree with that. There are really limited alternatives for wealth building, other than real assets, which households would consider to be their home, or their second home, or income earning assets that have appreciation potential. And that, to my mind, chiefly is going to be common stocks.
Chad, I look at it two ways. One, the market will may or may not, we don't know, have a correction. And it may be a correction where you might get nauseous, I don't know. But I think that the market will be higher at least 6 to 12 months from now, based pretty much on what Tom said. I think he's absolutely spot on. But the other thing is, people think about stocks like they would, I don't know, commodities, in sense like it's a diamond, or it's a piece of gold, or it's a piece of silver jewelry. A stock is an operating company. And, we, at least my team takes the view of, if you have an investment in a good company, it's got good, solid financials, it doesn't have too much debt, and it's operating fine, and it's doing its job, then there's no reason to sell it. We don't trade in and out of it like it is a commodity. We keep and hold it until the fundamentals of that company change. And I think everybody should take a look at their stock portfolio and say the same thing, that, okay, well, or, I got XYZ stock, it's performing well, it's increasing its earnings, it's got a great profit margin, it pays a decent dividend, or it may not, it doesn't have too much debt, and it's got a good 5-year runway. It'd be foolish to sell it to try to time the market.
Yeah, so I think it goes along really with that. Is next question is, when will value stocks potentially come back into favor? And I know we saw that actually in the fourth quarter of last year, even into the beginning of 2021 so far. Do we see this continuing?
I think so. The valuation disparity between large cap, technology-oriented growth stocks and value type stocks is dramatic, to use that word. It is dramatic. And typically, when the economy is coming out of a recessionary environment, cyclical stocks will do better. They have been depressed, and they have valuations that are completely cheap, in my view. And so value stocks, and where are these value stocks? Banks, for one. Construction, material companies, even utilities, particularly in fast-growing states. Those are the kind, and industrials as well. I think they are the sectors that are going to continue to do well. And these cycles last a long time. Coming out of a recession, value stocks typically will outperform for a few to several years. And given the valuation disparity that we see now, and given the liquidity bucket that the Federal Reserve is going to continue to provide to the economy, I think these are the stocks that are going to do well. The rotation has already started. It started in earnest back in September. And in the fourth quarter, value stocks outperformed the large cap S&P by like 25 percentage points. It's been quite dramatic. And I think that's just the beginning and not the end. I think we're going to see the cyclical part of the economy perform well.
You know, Chad, as you know, we're value, at least my team is value 24/7, 365. But I have a good analogy. You know, Warren Buffett and Walter Schloss were walking down the street in Manhattan, and Walter picks up a cigar butt, and he says, he starts puffing on it, and Buffett says to him, Walter, why do you pick up that cigar butt? He says, well, you know, it still had a couple good smokes in it, and it was free, so it didn't cost me anything. Well, if you think about value stocks, you're not overpaying for growth, and maybe something good will happen to it if you're a patient person. And, you know, we may not be as patient as Job, but we're certainly patient.
It's funny you say that, actually. I was watching an interview with Warren Buffett a couple of years ago, and he still picks up pennies when he finds them on the ground as he never doesn't skip picking up a penny, because every penny is worth a penny.
Yeah.
So our next question, and this is the last one, unless another question comes in the Q&A box. This question is from Bob, is the fall off in deposits a key reason that banks are reported to have been buying into things like Bitcoin and other cryptos? Interesting, because we debated a long time about a Bitcoin slide. We decided against it. Can you speak to that a little bit?
Tom?
I'll let Steve handle that.
Well, I was hoping Tom would talk about the monetary thing.
I will. Why don't you do? Then I'll.
Okay.
I don't know what you're going to say, so why don't you continue?
Because Tom's a monetary expert. But anyway, my point in Bitcoin is no, the institutions aren't doing that because of drop off of deposit. I don't think, but maybe Tom will change
Yeah.
it. But I think it's because it's Me Too. And that's what institutions do, Me Too. They see a trend, they don't want to be left behind. They're worried about being left behind at the party, so they Me Too it. They're often wrong. You know, they were wrong in buying all of those collateral debt obligations in 2007, 2008. They were wrong in buying those bad tranches of mortgage-backed securities in those pools, and they're going to be wrong again. Bitcoin is not a store of value. It's a digital entry on a blockchain. And the blockchain technology is good because there's some good things to it. Let's say, for example, IBM is getting together with Walmart to use blockchain on their supply chain. So if there's bad lettuce with E. coli, they can figure it out in 10 minutes instead of 10 weeks. So I think those applications are, it's not a medium of exchange. The way Bitcoin processes their mining, it's very slow. So you can't have a lot of transactions. I think MasterCard does 1 million transactions an hour, or maybe it's a minute, I'm not sure. Bitcoin can only do maybe 10,000 an hour. So it's not that. Is it a medium of exchange? No, you can't really, you know, exchange it like a currency. So yeah, I think they're just playing Me Too, and I think they're being awfully stupid.
Yeah, I mean, institutions, I think, are doing this because their customers want to do it. They're demanding some kind of digital currency or a digital wallet to be able to increase the speed and frequency of transactions. And I think they believe that this is the way to go. And Steve's absolutely right on this. Not only is Bitcoin not a medium of exchange, but as sophisticated and advanced as the technology is in terms of mining these coins, you have to have some kind of stability in a medium of exchange, and that is not Bitcoin, nor in my view, it ever will be.
Yeah, I think that's kind of a good way to close that out. So, you know, with that, gentlemen, that was our last question. As I mentioned, you know, compliance will get me if I don't put up our disclosure for today before we close out today. Any last comments that the two of you have for our audience as we close out today's presentation?
Yeah, I think Mike, compliance officer working on this, so it's a good job of putting that up there.
Great. Yeah, thank you everybody for attending today. We hope you enjoyed the presentation. Again, please fill out our survey. There will be at least one post-webinar email going out from Zoom today or tomorrow that will also include that late tomorrow afternoon. Again, I hope all of you have a great evening, and thanks for your attendance today.
Thank you.
Thank you.